Welcome to part two. Let's jump right into it because it could be a three-part or four parts. It's that detailed. So here we go. Where were we? Believe. Yes, the COVID-19 forever war. According to official stats, approximately 600,000 Americans have died in the past 2 years with a cause of death attributed to COVID-19. Approximately 400,000 Americans died during World War II. All human lives are precious. But to a domestically elected politician, those who die within your squiggly line domain are the most important. COVID-19 is already more destructive in terms of lives lost than World War II. This is further proof that pandemics inflict more misery and carnage upon the human condition than war, which is why the policy response to a pandemic can easily surpass that of a war. The modern city is a testament to the impact of infectious disease. Running water, sewer systems, and building codes were all changed dramatically or introduced in the 19th and 20th centuries to defeat various infectious diseases that run rampant when humans live in close quarters. Yeah, chlorination of the drinking water supply was the key turning point for a lot of major cities, like including London, New York, and so on, and having a proper sewage system, right? Getting that human waste away from you, right? US 2020 GDP. That's why what is going on in India, it kind of just blows my mind. They should be focusing on clean water and sewage systems first rather than wearing a mask, a piece of cloth. 2020 GDP declined the most since World War II. US 2020 GDP declined the most since World War II, and the budget deficit enacted to fight COVID also set a post-World War II record. All things are now possible in the name of COVID, especially since the onset. This could extend for many years, right? In terms of spending, especially since the onset, which kind of leads me to believe why the 2020s will be a huge expansionary decade, boom time decade, soaring 20s. Especially since the onset of the pandemic accelerate trends already in motion. Pay to play. Let's first analyze how the US government paid for the massive fiscal spending enacted in 2020. Owing to its status as the issue of the global reserve currency, America is in a unique position vis-a-vis its funding options. The majority of trade, as in commodities, are priced in dollars. And therefore, countries that are net exporters receive dollars for their goods. Unless they want to push up the value of their currency by selling USD and buying their domestic currency, a surplus country must buy a US dollar denominated financial asset. America must run an open capital account to fulfill its role as the global reserve currency issuer. In crypto, you have USDT, so Bitfinex should keep that tap open, right? I mean, right. And we're not even fractionally reserved on USDT, 74.6%, I believe. So you can easily amp that up to what, 50, 40%, 30%, why not 10%? Just asking a question. Most countries don't want to allow pesky foreigners to buy any type of financial assets. Most countries don't want to allow pesky foreigners to buy any type of financial asset, especially domestic property. This is why major economic powerhouses like China and Japan would refuse to take the mantle of the reserve currency issuer if it were on offer. Wow, interesting. They are perfectly happy with closed or semi-closed capital markets. Yeah, well, got to mull on that. I think he's right. I'm sure he's right. But I think, yeah, I need to clarify that in my mind a little bit more. But yes, closed or semi-closed capital markets, yeah. Traditionally, due to their liquidity and perceived risk-free nature, surplus countries recycle the exporting revenue into US treasuries. Like think of the Saudis, think of China, Japan. The US Treasury publishes monthly Treasury International Capital tick data. It details in aggregate who holds which type of USD financial assets. From 2002 to 2019, foreigners purchased 42% of all net US Treasury issuance. The Fed purchased 13% at the margin. The purchases by foreigners helped the US government finance its budget deficit at reasonable interest rates. Trouble is, US never actually uses that money to build anything like big infrastructure projects or actually helping the populace, right? Maybe things will change, but I doubt it. That all changed in 2020. COVID destroyed global trade and laid bare the ineffectiveness and underinvestment in public health globally. Governments around the world are scrambling to figure out how to pay for shutting down their economies to halt virus transmission, securing PPE in vaccine supplies and upgrades to their public health system. They need all the money they can beg, borrow, or print. Just be easier to get the population healthy, you know? That doesn't make money for the corporations who sell you junk. Unfortunately, most countries cannot be as generous with the expansion of government spending as America. If countries level up their fiscal spending by printing money, it will likely trash their currency and lead to commodity price inflation, followed by social unrest. If the plebs don't get the bread, you won't have a head. Boom. What a line. If the plebs don't get their bread, you won't have a head. The America First mantra comes in different flavors, but both Democrats and Republicans promote it. There's a general consensus that policies that help wage earners, like onshoring manufacturing, infrastructure spending, and import tariffs, are the right thing to do for the first time in 50 years. Unfortunately, these policies are inflationary. And if you are a holder of US paper, you are shaking in your Virgin Galactic space boots. I did a quick and dirty estimation of the amount of interest rate risk held by foreign holders of US treasuries. SIFMA provides a table that breaks down the US treasury issuance by maturity. I looked at the current composition of the outstanding treasuries and used those ratios to compute an estimated portfolio of foreign holders. I then used the Dura function on Bloomberg to calculate the modified duration of each type of note or bond. A treasury note has a maturity of between 2 and 10 years. This also includes floating rate notes. A treasury bond is anything over 10 years. Yeah, which is 20 and 30-year bonds and TIPS, Treasury inflation protected securities, something like that. I calculated a weighted average duration of 17.08 years for foreign holders. Dollar value of 1 basis point equals USD face value times by duration times by 0.00001. Equals 6.46 trillion times by 17 years times by 0.001 equals 12 billion. That number might not mean much, but it's a fucking enormous amount of interest rate risk. Okay. If interest rates rise by 1% or 100 basis points, I very loosely estimate foreigners will have mark-to-market losses of 1.2 trillion. Whoa. Given that the notional as of March 2021 was 6.46 trillion, a 100 basis point rise in interest rates results in close to a 20% loss. Can I get a negative convexity? Whoop, whoop. Holy moly. 1% rise in interest rate results in a 1.2 trillion loss. Freaking A. Remember, if you are long bonds, you are short interest rates. Rising interest rates are bad news bears for bondholders. If you're a large foreign holder of US treasuries and the government tells you that it prefers a policy of inflation to support its domestic middle class, you run for the exits. That is why in 2020, when the US government made it rain, foreigners went on strike and only purchased 8.39% of issued treasuries. Who made up the difference? This whodunit is quite easy. What happened in 1939 when the Treasury needed a sucker to buy bonds that were too expensive? They called it, quote, independent, unquote, central bank and told them to step the fuck up. In 2020, the Treasury didn't even have to ask. The Fed purchased 55% of all treasuries issued. This is why the Fed's balance sheet grew 76% in 2020. Check the chart. Blue, foreign purchases. Bam, down. Red, Fed purchases. Boom. They stepped up the fucking game, didn't they? Stepped up to the fucking plate. Don't forget about the foreign bond bag holders who will come back to their predicament later. We will come back to their predicament later when we talk about policy options for the USG for the rest of the decade. There are a few technicalities that help the Fed maintain their narrative that it's not just running a money printer. There are a few technicalities that help the Fed maintain the illusion of the narrative that it's not just running a money printer to pay for the government's bills. The Fed has not set an explicit target for government bond yields. It appears they prefer an orderly, non-volatile rise in yields to some level that we don't know yet. Because they haven't set a target, they can say with a straight face they are not engaged in yield curve control. Nice. That is important because remember when Governor Eccles said earlier, if the Fed is doing yield curve control, their balance sheet will expand to whatever level is necessary to keep yields at or below their target. As the balance sheet grows and expands, so does the money supply. And that creates the environment for inflation. The Fed's liabilities are not legal tender. Boom. In English, the Fed doesn't just print money and spend it directly from their account. Instead, they engage a little game or ring around a primary dealer desk. Yes, this is kind of key. The Treasury has a Treasury auction. The primary dealers bid on bonds. I think they have a contractual obligation. If they become a primary dealer, these banks, they have to step up and buy a certain amount of bonds. And the Fed immediately buys the bonds from the dealers at a small markup. Wow. Jesus Christ. Everybody wins. The US government gets their wampum. It's about wampum shells, if you don't know, by the native Indians who use that as currency. The banks get paid to take zero risk. Boom. And the Fed gets to claim they are not directly financing the government. You understand the games that are being played? 2020 was a blowout year. Crypto went to the moon and is currently reeling under the awesome effects of Earth's gravitational pull. Are we done yet? ? Will the Fed's balance sheet continue to rise, taking all types of financial assets with it? Let's peer into Pepe's crystal ball. Check the Bitcoin price. 36,342. Taper tantrum. Monetary inflation is only a problem when it manifests in politically unacceptable ways. The prices that concerns politicians the most are the price for labor, wages, and the price of food and energy. The US government, USG, kind of shut down the economy. They did. When COVID-19 hit and sent out checks for everyone's troubles. 1, 2, buckle my shoe. 3, 4, out the door to punt stonks on Robinhood with stimmy checks. The minimum wage in most states, when you add up all the various government checks, is now $15 to $20 an hour. Whereas pre-COVID, many states have statutory minimum wage below $10. Businesses are now complaining that the generosity of the government prevents them from hiring enough workers. Stimmy checks absolutely prevent businesses from hiring workers at the old low wage level. But the solution is to pay more. After 50 years of losing out to capital, Labour isn't going to accept anything other than continuing real wage growth. There is an election coming up in 2022. Another one. It never stops over there. Red or blue? If you don't hand out the goodies, someone else will run on the Made in America pro-union high-wage platform and trounce the pro-business candidate who'd rather prioritize capital returns. The zeitgeist has changed, people. I saw this meme somewhere else. The price of lumber is too darn high. Take me somewhere expensive, darling. It's like Lowe's or Home Depot. In the UK, it'll be B&Q or Wickes. The fact that memes on social media are poking fun at the ridiculous prices paid for lumber in America tells you that inflation is here. And more importantly, people know it is here. Yeah, you can't hide it. When you go build your deck, it's costing you 4 or 5 times as much, right? And people doing home improvement projects, right? Stuck at home, right? Just fiddling around with something here. Not that you guys are dirty. The fact that the memes are, as a result of wage and raw materials inflation, there's part of the establishment hooting and hollering that the Fed needs to slow down and raise interest rates. Or, at the very least, reduce the pace of its balance sheet growth. It doesn't help that the April CPI index print was the highest in decades. CPI is a government calculated index that is supposed to measure inflation in the real economy. If the Fed cares about fighting inflation, then all the signs are there, and now they need to change course. At the same time, the White House is having trouble getting crucial votes in the Senate to approve the next multi-trillion-dollar infrastructure deal that comes with tax hikes. It appears that the urgency of the COVID pandemic waned enough for the usual partisan politics to reappear. They always reappear. 2 things need to happen for the Fed's balance sheet to continue growing. The US government needs to continue spending aggressively. The Fed needs to buy the majority of bonds issued so that the interest rate remains at affordable levels for the USG. It appears that both of these conditions are being questioned by policymakers. That is no bueno for my investment thesis. Now, I will explain why this taper tantrum will fade, and the USG will get back to business as usual, with the USG swiping the Fed's US dollar credit card swipe and providing the fiscal goodies necessary. Risk of a declining Fed balance sheet, foreign bag holders. Okay, it's going to break it down for us. Remember those foreign treasury holders who decided to purchase 80% fewer newly issued treasuries? What can they do with their dollars? The Bloomberg compiled US GDP economic forecast for 2021 stands at 6.5%. If that comes to pass, it will be the fastest growth since the early 1980s. I mean, when you shut everything down for a year, it's pretty easy to grow, right? While politicians prefer supply chains to be onshored, this doesn't happen overnight. Yeah. China, Germany, and Japan are going to earn buku USD by producing knickknacks for the American consumer who is binge spending courtesy of their stimmy checks. Yeah. amount of stuff Americans buy. Yeah, that's what is the public storage companies to house all the crap. They're like locusts. They need more, always need more. Japan and China are also the number one of the and two largest holders of US treasuries. Respectively, they earn the most amount of dollars and therefore hold the most amount of US treasuries. In order to stand still on their stock or treasuries, they need to buy a different set of USD assets that aren't being explicitly devalued by inflationary government policies. The US stock market, and specifically the post-COVID behavior beneficiary, tech stonks blew the doors off in 2020. Instead of buying bonds, foreigners got smart, went to equities bigly. Mm. 2019, about 8.5 trillion. 2020, about 11.5 trillion. 2020 annualized, basically 14.5 trillion. In 2020, foreigners purchased 2.45 trillion worth of stonks. Freaking A. There's your buyer, right? That's approximately, I think I saw a post where, is it global stock markets are worth 95 trillion? Is the global GDP of the world like, I'm not too sure now. I think it may be less than 95 trillion. Have we gotten to the point where stocks are beginning to have a multiple of price to global GDP? That'd be an interesting chart. Can I do that quickly? Stocks priced in global GDP. Hopefully someone's done this for me. That would be kind of cool. Stocks traded total value percent of GDP data World Bank. This could be good. Yeah, I think so. Somebody's did it for me. So 1985. Here we go. This is how you financialize your stock market. 1985, 1984, 17.6% stocks priced in GDP. Oh, thank the Lord. Who did this for me? Okay. The 2000 top, 145% stock market valued against global GDP. Right? That's a multiple 1.45. 2008, 2007 peak, 161%. 2015 peak, 162%. And 2019, 87%. I don't have any more data beyond that. 2019 is the last data point, 87%. So, but the highs are getting higher, lows are getting higher. It's the uptrend. And like I said, 1984, 17%. I think we next peak may hit like 175, 180, or it just continues this burn for the rest of the decade, hitting like 200, something like that. I don't know. We'll find out. Instead of recycling the export income into treasuries, foreigners bought stock instead. Smart, isn't it? Finally, which benefit from low interest rates and expanding Fed balance sheet. Foreigners still hold 7 trillion worth of treasuries. Interest rate number go up is bad juju for long bond and equity holders. Should the Fed even hint that it will bring forward a date at which it raises short-term rates and or reduces the monthly purchase of bonds, two things will happen. I think we go to negative rates in America. I think it's almost there. Once the equity market will tank, One, the equity market will tank as foreigners dump stock. The fastest human in the world is a Fed governor backtracking their policy if the S&P goes down 20%. Two, Treasury yields will scream higher. Let's put scream higher into context. 100 basis point increase in rates is enough to tattoo the word wrecked on all financial asset classes. Boom. Get that tatted on your ass. Almighty USG. I'm going to read this paragraph. Oh, that's a long one paragraph. Oh, can I? I've got a few more minutes before my voice gives out. Okay, the almighty USG. Every regime implicitly or explicitly promises its subjects something in return for their support. The architects of modern US kind of sort of welfare state were Presidents FDR and LBG, Lyndon Johnson. I forget what the B stands for. If the population saves, it doesn't spend. The primary big lumpy expenses that modern governments attempt to smooth out outright pay for are primarily healthcare related. While US healthcare is not completely free, the US does provide free or heavily subsidized care for the young, old, and poor. The most important cohort to politicians is aging workers. The boomers are the largest and wealthiest cohort in America. Old rich people vote. Therefore, if you're a politician, you always support things they care about. Old rich people care about healthcare. As they grew into productive adults, the boomers were promised affordable, almost free healthcare as they aged. Medicare. In addition, they were promised a dignified retirement paid for by Social Security. This is kind of key. In return, they spent most of what they earned in pursuit of the American dream. A mansion filled with knickknacks, a pantry stocked full of cheap processed food, and a two-car garage with a pickup truck and SUV filled with cheap gas. That is how the American consumer powers 60 to 70% of annual GDP. Contrast this with China. So they're actively turning Indians in India into being consumers, separating them from family, the church, and their older held traditions and culture. I see this on Instagram a lot. It's shocking, like some of the scanned stuff that goes down on Indian Instagram. But it's okay. Do what you want to do, people. Which does not provide healthcare for nor guarantee retirement incomes for most comrades. The population at some point, China will go social, bring in some sort of welfare, right? At the moment, it's like bitches get to work 12 hours a day, and they're like, okay, we'll get rich. Let's do it. The population saves aggressively, and it's one reason why Chinese consumers only account 30% to 40% of annual GDP. That's still quite a large number, right? But they'll bump it up to 50, 60. The USG spending line items on Medicare, Medicaid, and Social Security are together called entitlements. The population feels they are entitled to healthcare and retirement paid for by the government. Any politician that attempts to reform these third rails faces electrocution at the ballot box. Yeah. Defense spending almost never declines because being the world's policeman is expensive, especially when the goal is to ensure cheap energy commodities produced in socially unstable regions make their way to America all day, every day. I love how you breaks down complex geopolitical and even US domestic policies, boom, into like one sentence. The problem with entitlements and defense spending is that these are real, not monetary goods. No matter how hard the Fed tries, it can't print more nurses, hospitals, or aircraft carriers. As the population gets progressively sicker and older, the already expensive healthcare system will phase shift into another universe of expensiveness. Check this, bro. According to the US Census Bureau, from 2010 to 2019, the 65 and older population increased 7.74%. Freaking A. Americans are old and fat and sick. Over the same period, Medicare and Social Security expenses grew 48.52%. For each 1% increase in old folks, their expense to the government grew 6%. Boom. Let's just kill them off with a pandemic that attacks the elderly with poor immune systems. That'll solve one problem. Over the next decade, approximately 42 million individuals aged 55 to 64 become 65 and above. Wow. This is the wave of boomers retiring, right? Are boomers that young? Baby boom, post World War II. Isn't it 1944 to 1965 or something? That's the baby boom generation. Okay. Assuming that no one dies, that's 13% of the population or who begin aggressively drawing on government support between now and 2030. That would necessitate another 78% increase in healthcare and retirement spending. F me, assuming the current trend holds. Appreciating the magnitude of healthcare, retirement, and defense spending is the goal of this exercise. The next issue is how the USG will pay for increasing costs or programs essential to the compact deal that they made with the people. Given the immense amount of fiscal spending that is already happening, many people believe that now the USG will resort to aggressively raising taxes on capital to pay increasing expenditures. Good job they got a decrepit old man in charge now, isn't it? Tax receipts as a percentage, who's a lefty who wants high taxes. Tax receipts as percentage of entitlements and defense spending. Okay. So overly funded, but the trend, look at it, got down to 100% in GFC, went back up to 130, and trend is down, right? But the costs are going to go up, so this will go down even more. So it has to do something, right? This chart displays what percentage of the total spend on Medicare, Medicaid, and Social Security and defense is covered by annual tax receipts. The takeaway is that taxes now barely cover 100% of the costs, down from 200% of the cost 20 years ago. Of the last 20 years, the presidency was held by a Republican 60% of the time and a Democrat 40% of the time. Regardless of which party was in power, expenses rose faster than income. These programs cost increased 207% from 2000 to 2020, while tax receipts grew 83%. If we extrapolate this trend out another decade, tax receipts will only cover 90%. The government still has roughly 30 to 40% in additional budgetary items that need to be paid for and above entitlements and defense spending. This assumes that productivity and economic activity will not be affected by higher tax rates. It is a spurious assumption. This is why wages will double in America. Higher wages, higher tax receipts. It is a spurious, and also higher wages will increase the velocity of money and expenditure, right? For poor people who are not used to that new money hitting their bank accounts. So now they are used to that money hitting their bank accounts. They're not going back, right? It is a spurious assumption that humans will produce the same or more when they take home less and less from their efforts. It is a spurious assumption that humans will produce the same or more when they take home less and less from their efforts. Yeah, incentive structures matter. Incentive structures matter. Taxes are never able to cover all the goodies the government promises. The USG, like all governments, will borrow to meet their societal obligations. This is especially true when the cost of doing so is comparatively cheap. In this case, because the USG possesses the printing press to the world's reserve currency. No choice but up. Have I got enough juice in my tank to read all this? Ooh, I'm going to break this up to another part. Yeah. Let's look at that first chart though. Tomo repo. Okay, this is going to be complex. Yeah, I'll break up to another video. Yeah, okay. Biology. Shutting it down. Cheers, people. Thanks for watching. Bye.